So you've made a smart move, diving into real estate investment here in the US. Maybe you've even teamed up with partners, pooling your cash and your know-how.
A common strategy, yeah.
And smartly, someone probably told you, form an LLC, a limited liability company. It's supposed to be the gold standard, right? Protect your personal stuff.
That's the promise, absolutely. It's designed for that exact purpose.
Feels like getting that LLC set up is the big win. You know, the shield is up, your house, your savings, your future, all safe if something goes sideways with the property, like a tenant gets hurt, or there's a fight over the property line, maybe a contractor flakes out.
And look, when it's done right, that shield is real. An LLC, properly formed and maintained, it does create that critical legal separation.
Okay, but here's the thing. What if just forming it, getting that piece of paper from the state is only step one? Like the absolute bare minimum.
Where are you going with this?
What if a few maybe kind of simple sounding mistakes in how you set it up, or maybe some key things missing from one really important document, what if that could just completely wreck that protection? Leave your personal stuff hanging out there after all?
That happens. It really does.
Or maybe even more likely when you've got partners, what if you start arguing about fixing the place up or when to pay out profits, and everything just grinds to a halt because you never actually agreed on the rules beforehand?
That's exactly the gap we see too many investors fall into. They get the why have an LLC, but they miss the vital parts of the how to set it up right, how to, write down the internal rules, and how to keep it legally sound over time. They think the shield's solid, but it's got holes.
And that's precisely why we're digging into this today. We've gathered a bunch of sources you shared, detailed stuff from legal and tax pros like Anderson Business Advisors, guides from places like UpCounsel, even practical templates from Northwest Registered Agent.
Right, and deep dives into specific clauses, too, from The Lawyer's Mentor, the WA Business Law blog.
And importantly, the official word straight from the IRS on Schedule E. That's the form for reporting your real estate income and losses.
Taken together, these sources give us a really a powerful multi-angle view. It's not just theory. They lay out the practical steps, the requirements, and the potential traps. It shows you how to make sure that LLC structure actually does what you want it to do, protect you, and help manage the investment, especially when you're working with partners in the U.S. market.
So our mission here, to pull out the absolute must-know info, the essential takeaways from all these different reliable viewpoints. We want you to understand the real power and the risks of using LLCs for real estate in America.
And maybe more importantly, shine a light on those common, easily overlooked mistakes that can cost you big time.
Exactly. The goal is you walk away understanding what it really takes to keep your investments growing, legally protected, and managed, confidently. So let's start with the basics again. We know why investors use LLC as asset protection. Can you just unpack that fundamental benefit a bit more?
Absolutely. The main appeal, the number one reason, is that limited liability. See, it creates a formal legal entity separate from you, the owner, the member.
Right, the legal wall.
Exactly.
Yeah.
That separation builds the wall. So if the LLC owns the property and something happens related to that property, tenant sues over a bad step, contractor puts a lien on it, maybe an environmental issue pops up years later.
Mm-hmm.
The lawsuit is typically against the LLC, not you personally. The liability is limited, ideally, to the assets inside that LLC. Your personal stuff, your home, your savings account, your car, other investments you hold outside that specific LLC, they're generally shielded from those business debts and lawsuits.
That limited liability, that's the big headline, the main draw.
Yep.
But the sources hint there's more to it than just the shield, right? Other strategic perks.
They do. Beyond just protection, LLCs offer flexibility. Right. A big one is tax planning. Depending on how many members you have and what you're trying to achieve, an LLC can actually choose how it wants to be taxed by the IRS. Well, for federal income tax, a single-member LLC can be a disregarded entity, basically like a sole proprietor. A multi-member usually defaults to a partnership. But here's the key. You can elect to be taxed as an S-corp or even a C-corp.
And those choices have different tax results.
Hugely different. How income and losses flow, how they're taxed. It can make a big difference. Choosing the right one can lead to, significant tax savings or better planning options. We'll definitely get deeper into that when we hit the IRS stuff later.
Okay. What else besides taxes?
Another thing investors often like, mentioned in the sources, is anonymity, or at least more privacy.
How does that work?
Well, the state filings usually list the registered agent, maybe the organizer, but they don't always require listing all the members' names publicly. especially if you set it up as manager-managed or use layers, like a holding company owning the property LLC.
Ah, so your personal name isn't necessarily plastered all over public records tied to the property address?
Right, which can appeal to, high-profile folks or just anyone who prefers to keep a lower profile with their investments.
Okay, so powerful stuff. Asset protection, tax options, maybe some privacy. Good reasons to use an LLC. But like we said, and the sources really hammer this home, just forming it isn't enough. It's just the first piece of paper.
Exactly. It's the starting line, not the finish.
The sources point out that critical mistakes in the setup, and just as importantly in the ongoing management, can totally gut the benefits you thought you had. You think you're safe, but these common slip-ups can leave you exposed.
That's the core issue we're tackling. And that Anderson Business Advisor source, it lays out 13 specific, really common, and potentially devastating mistakes that real estate investors in particular seem to make. They're like traps waiting to spring.
All right, let's pull back the curtain on these 13 traps using that Anderson list. Trap number 1, delaying formation. Sounds super basic, but what's the actual danger if you don't get the LLC paperwork filed before you start making moves?
The danger is immediate and personal. Liability rests squarely on you. Think about it. You find a great property, you start negotiating, maybe you even sign the purchase contract or put down earnest money, or you start advertising it for rent. If the LLC isn't officially registered with the state yet, who's doing all that?
Me personally.
You are,
Hey.
as an individual. You're personally signing those papers, taking on those debts, making those promises. If anything goes wrong before the LLC exists, the deal tanks, and there's a fight over the deposit. A contractor you hired early on messes up, you say something about the property that leads to a lawsuit.
It all comes back to me.
The claim is against you, John or Jane Doe. The LLC didn't exist, so it can't be held liable. That structure, that legal entity, has to be officially formed and recognized by the state before you take any action in its name related to buying, owning, or managing that property, period.
That makes total sense, like trying to block a punch with a shield you haven't picked up yet. Okay, trap number 2, choosing the wrong state to form in. Or maybe messing up registration when you operate somewhere else. You hear a lot about states like Wyoming, Delaware, Nevada having advantages. Maybe privacy, maybe better laws about creditors. Is forming there good enough if my rental property is, say, in California?
This is a huge point of confusion and, yeah, a really common, costly mistake. While, states like Wyoming or Nevada might offer certain legal benefits if that's genuinely where your business operates, or if you structure things very carefully with holding companies.
Right.
Simply forming an LLC there, maybe in Wyoming, and then turning around and owning and managing property in California without also registering in California, that's a critical fail.
Why? What's the issue?
Because California, where your property physically sits, where you're actually doing business, collecting rent, managing, maybe renovating California, requires any business operating within its borders to be registered there. If your Wyoming LLC is doing business in California, California sees it as a foreign entity. Foreign to California, that is. You must file paperwork with California to register that Wyoming LLC as a foreign LLC, authorized to do business in California.
So that means dealing with 2 states.
Often, yes. Paying fees in both, staying compliant in both. Wyoming, where you formed it, and California, where you're operating.
And if you skip that California registration, that foreign filing,
the consequences can be pretty harsh. The big one is California might block your LLC from using its courts.
meaning
Meaning if you need to sue a tenant in California for unpaid rent or go after a contractor for bad work on your California property, a California court could just toss your case out. Why? Because your Wyoming LLC wasn't properly registered to do business there. You lose your right to sue in that state.
Wow, that completely undermines the point of having the LLC protect your investment there.
Totally. It neuters your ability to enforce your rights related to that property in that state. Plus, you could face fines from California for operating without registration.
So, bottom line, register where you form and register as a foreign entity anywhere else you own property and are actively doing business.
Exactly right. State of formation plus state of operation.
Okay, trap number 3, acting as your own registered agent. Is this just about trying to save a little money?
It's really more about privacy and reliability. See, the registered agent, that's the LLC's official point of contact for legal stuff. Service of process, like if your LLC gets sued and official notices from the state, they go to the registered agent.
And
the name and the physical address of that registered agent become public record. Anyone can look it up online. So if you list yourself using your home address.
my home address is public, linked to the business.
Yep. Link publicly to your LLC. Opens you up to junk mail, maybe unhappy tenants showing up or just unwanted attention. Using a commercial registered agent service like the ones Anderson mentions or Northwest offers gives you a professional, stable address for those critical documents. It keeps your home address private. And it helps ensure important legal mail actually gets received reliably, even if you're out of town or you move. Missing a lawsuit notice because you were on vacation, that could be catastrophic.
Which kind of leads right into traps 4 and 5. Using a P.O. box or just not setting up a proper business address at all. If I shouldn't use my home address for privacy, why not just use a P.O. box for the LLC's address?
Because most states require a physical street address for the LLC's main business location and for the registered agent. A P.O. box is just, well, a box at the post office. It's not a physical place where someone could serve legal papers or theoretically visit during business hours.
So the state might reject it.
They might deem your LLC non-compliant, which risks its good standing and potentially that liability protection you want. It just doesn't look like a legitimate, properly established business if you're using a P.O. box for required physical addresses.
Okay, so if I need a physical address but I want to keep my home private, what's the actual solution the sources suggest?
That's where Trap 5 comes in, failing to set up a proper business address that isn't your home. The go-to solution, highlighted by services like Anderson Advisors, is using a virtual business address or a mail forwarding service that provides a real street address.
Like a mailbox place, but with a street address.
Exactly. It gives you a professional address for the public record, meets the state's physical address rules, but keeps your personal residence private. You avoid the non-compliant P.O. box issue. It reinforces the idea that this is a separate business operating from a distinct location, not just you running things from your kitchen table. Maintaining that separation, visibly and on paper, is so important for upholding the LLC's legal integrity.
It really sounds like these small details, like addresses, they all add up to maintain that legal wall. All right, trap number 6. Overlooking startup expense reimbursement. What's this about and why is it important?
Okay, so before your LLC is officially formed and has its own bank account opened, you, the organizer or soon-to-be member, are probably paying for initial costs yourself, right?
Sure, filing fees, maybe lawyer fees.
Exactly. State filing fees, lawyer fees to draft documents, maybe costs for some early marketing, travel to look at properties. Once the LLC is formed and has its own money in its own bank account, the LLC needs to formally pay you back for those legitimate business expenses you covered personally.
Why is that reimbursement step so important?
A couple of reasons. First, it keeps your personal money totally separate from the LLC's money right from the start. You didn't invest that money as capital. You were repaid for expenses the LLC itself should cover. Second, it makes sure those costs get recorded correctly on the LLC's books, not yours. This allows the LLC to potentially deduct them as startup costs later.
And you need proof of this.
Yes, it needs to be documented. Either a clause in your operating agreement that acknowledges these pre-formation costs, or maybe a formal company resolution written down in the LLC's records after it's formed, spelling out exactly which expenses are being reimbursed and to who. If you don't do this, the accounting gets messy and it starts blurring that line between personal and business finances again, which, as we keep saying, is bad for maintaining the liability shield.
It's about showing the LLC has its own financial life, separate from you, right from day one.
Precisely. One more piece of evidence that it's a distinct legal and financial entity.
Okay, moving to trap number 7. Picking the wrong type of LLC structure, member-managed versus manager-managed. How are they different, and why does this choice matter so much, especially with multiple partners in a real estate deal?
This choice basically dictates who has the legal power to sign contracts for the LLC and make the day-to-day decisions. In a member-managed LLC, which is the default in many states, if you have multiple members, all the members generally have equal authority to act for the company, unless your operating agreement says something different.
So any partner could sign a lease?
Potentially, yes. Which might work fine if it's just, say, 2 or 3 partners who are all super active and communicate constantly. But as the Northwest template source points out, in multi-member setups, this structure, without a clear operating agreement defining roles and how decisions are made, that's most likely to end up in dispute.
Because everyone can do it, but no one knows who should.
Exactly. Who hires the plumber? Who approves the big renovation budget? If everyone has authority but there's no clear process, you can get chaos or just total gridlock. The Northweb template actually suggests that even within a member-managed setup, you should use the operating agreement to assign specific roles or require majority votes for certain actions.
Okay, so what's the alternative? Manager managed.
Right. In a manager-managed LLC, the members hand over the management authority to one or more specific managers. These managers could be members themselves, or they could be outside people, or even another company. The managers run the daily operations, hire people, sign the contracts, etc.
And the members who aren't managers?
They typically don't have the authority to act for the LLC just because they're members. This structure is often better when you have passive investors who just put in money but don't want to manage. Or if you want a clearer decision-making chain, or going back to privacy, if you want only the manager's name potentially public while the members stay behind the scenes.
So picking the wrong one could lead to, like, operational nightmares or someone acting without real authority.
For sure. It has to match how you actually plan to run the business, who's doing what, and what your goals are for privacy and efficiency. And the operating agreement was where you lock that choice down and spell out who has what power. Got it. All right, trap number 8. This sounds huge and hits the tax side, selecting the wrong tax status for the LLC. This happens when you get your employer ID number, the EIN, from the IRS, right? What are the choices, and why is getting this wrong so bad? This is, one of the absolute biggest decisions you make after forming the LLC. When you apply for that EIN, you essentially tell the IRS how you want the LLC to be treated for tax purposes.
What are the usual options?
Okay, so a single-member LLC, by default, is a disregarded entity. Taxed just like a sole proprietor, Schedule C for an active business. Schedule E usually for rental income. A multi-member LLC, by default, is taxed as a partnership. It files its own informational return, Form 1065, and then issues K-1 forms to each member, showing their share of the income or loss, which they then report on their personal tax returns, often on Schedule E. But here's the key flexibility. Any LLC, single or multi-member, can elect to be taxed differently. By filing special forms with the IRS, Form 25553 for an S-Corp election, or Form 8832 for a C-Corp election, you can choose those tax statuses instead.
And the implications are big.
Oh, huge. As the sources, especially Anderson, point out, the tax consequences are vastly different. For example, making an S-Corp election might be good for someone actively flipping houses or developing properties. They have active business income, subject to self-employment taxes. As an S-Corp, they could potentially save on those payroll taxes by paying themselves a reasonable salary and taking the rest of the profit as distributions, which aren't subject to self-employment tax.
But the sources specifically warned about using S-Corp for just holding rental properties long-term, didn't they?
They did, and that's a critical distinction. S-Corp generally are not the best choice for passively holding rental real estate. There are complex rules around passive income and how distributions are taxed that often make the default partnership or disregarded entity status much simpler and potentially more tax efficient for typical rental income flowing through to Schedule E.
So choosing the wrong status, maybe because you heard S-Corp save taxes without understanding the specifics for rentals,
can lead to major tax headaches. Inefficiencies, surprise tax bills, maybe even attracting unwanted IRS attention. You really need to match the tax election to the type of real estate activity you're doing, active business versus passive holding.
And it's not just making the election, it's living with the consequences. Which brings us to trap number 9. Failing to put yourself on payroll if you elected S-Corp or C-Corp status, or, conversely, messing up how you take money out if you're taxed as a partnership or disregarded entity.
Exactly. This flows directly from that tax choice. If you choose S-Corp or C-Corp taxation and you're actively working in the business managing properties day to day, not just collecting checks, the IRS expects you to pay yourself a reasonable salary through a formal payroll system.
Meaning W-2, withholdings, the whole 9 yards.
Yep. Payroll processing, withholding income tax, Social Security, Medicare, filing payroll tax reports. If you don't pay yourself a reasonable salary as an S-Corp or C-Corp owner employee, that's a huge red flag for the IRS. They could reclassify your distributions, the money you took out without payroll taxes, as wages, hitting you with back payroll taxes plus penalties and interest.
Ouch. And what about the flip side? If you stuck with the default partnership or disregarded entity status?
Then you cannot be on payroll as an employee of the LLC. Your income isn't salary. It's your share of the LLC's profits. You take this out as distributions or owner's draws. These are taxed differently, sometimes subject to self-employment tax if it's active business income, but generally not if it's passive rental income.
So putting yourself on payroll when you shouldn't, or taking only draws when you should be getting a salary.
Shows you either don't understand or aren't respecting the tax structure you chose. Both can lead to audits and penalties. Your compensation method has to align with your LLC's tax selection.
It really sounds like that tax selection is a major fork in the road, and then you absolutely have to follow the rules of the path you picked.
That's a great way to put it. Get the election right for your situation, and then operate the business, including how you pay yourself according to those rules.
Okay, now let's talk about what so many sources call the absolute linchpin, the rule book for your LLC. Trap number 10, skipping the operating agreement. We called it the backbone. Why is it so vital, especially if you have partners in a real estate LLC?
The operating agreement is the internal contract. It's the agreement between the members of the LLC. Think of it like the company's constitution. Now, technically, some states don't legally require you to have one just to file the LLC formation papers, but every single source we looked at basically screams that it's absolutely essential. It governs pretty much everything about how the LLC works internally, how much money each person puts in initially, whether you could be asked for more later, how profits, losses, and actual cash get divided up, how decisions get made voting, who decides what are the roles and duties of the members or managers.
And importantly, what happens if someone wants out?
Crucially, yes. What happens if a member wants to leave, or dies, or can't participate anymore? How do you handle disputes? How does the whole thing eventually wrap up or dissolve? For multi-member real estate LLCs, this document is just paramount because, like the Northwest source said flat out, multi-member companies without a clear operating agreement are the ones most likely to end up in dispute. Partners just have different ideas about things.
And without your own agreement.
The state's default LLC rules apply. And those default rules might be totally different from what you and your partners actually wanted, especially for real estate stuff like needing more cash for a big repair, deciding on a refinance, or agreeing when to sell a property.
So it's not just like a nice-to-have formality. It's critical for internal peace and clarity. Are there external reasons it's so important too?
Oh, absolutely. And these are deal breakers, banks and lenders. They will demand to see a signed and dated operating agreement before they'll even let you open a business bank account for the LLC.
And without a bank account?
You can't keep the finances separate, which, as we'll get to, is another huge mistake. Trap #12. Lenders also need it for loan applications. They want to see how the company's governed internally. And maybe most importantly, as Anderson highlights, if someone ever challenges your LLC's liability protection in court.
Trying to pierce the veil.
Exactly. The operating agreement is Exhibit A, showing that your LLC is a real, functioning entity with its own rules and structure, separate from you as an individual. It's essential for defending your structure. Skipping it. It's like trying to build a house with no foundation at all.
That really drives home how critical it is. Operational, legal, financial foundation. Okay. Trap number 11. Signing documents in your own name instead of correctly identifying yourself as acting for the LLC.
Right. Once the LLC is formed and you're doing business as the LLC, you absolutely have to make it clear you're acting as its representative, not just as yourself.
How do you do that practically?
It means when you sign things, contracts, leases, loan papers, whatever, you don't just sign John Doe. You sign something like John Doe, manager of XYZ LLC, or Jane Smith, member of XYZ LLC. The exact title depends on your role and whether it's member managed or manager managed as laid out in, guess what, your operating agreement.
And if you forget and just sign your name,
it creates ambiguity. A lawyer on the other side, or even a judge could argue, hey, maybe John Doe signed this personally, not for the LLC. And boom, that opens the door right back to personal liability. And Anderson adds another layer here. If it's a manager-managed LLC, where only the managers have signing authority, and a member who isn't a manager signs a contract, not only could that member face personal liability for signing without authority, but the contract might not even be binding on the LLC itself, because the person who signed didn't legally have the power to commit the company according to its own rules.
So you have to know your role, know the structure, and sign exactly right every single time.
Sounds tedious, I know, but yes. It's a small detail with potentially massive consequences for that separation we keep talking about.
Okay. Trap number 12. Not opening, and crucially, using a separate business bank account for the LLC.
This one gets called non-negotiable over and over in the sources, and for very good reason. Commingling funds, mixing your personal cash with the LLC's cash in the same account, is probably the single fastest way for an opposing lawyer to argue that your LLC isn't really a separate entity after all. It's just you operating under a different name.
So if I pay the property tax bill from my personal checking or deposit a rent check into my personal savings, I'm hurting the LLC's protection.
You are absolutely eroding it. Every time you blur those financial lines, you're weakening the argument that the LLC has its own distinct financial life. If you end up in court, showing you religiously used a separate bank account, all business income in, all business expenses out, is fundamental proof you respected the separation. Failure to do that, that's Exhibit A for piercing the corporate veil.
Seems so basic, yet probably easy to slip up on, especially when starting out.
It is. Maybe cash flow is tight, or you're just used to paying bills personally, but it's a bright, bright line you just cannot cross if you want that liability protection to hold up.
Got it. Separate account. Use it religiously. Finally, trap number 13. Neglecting proper books and records. Why is keeping good accounting records so important beyond just, filing taxes once a year?
Accurate. Organized financial records are vital for a whole bunch of reasons, as Anderson points out. First, yes, tax reporting and compliance. The IRS instructions for Schedule E basically demand you have records to back up every number you report. Can't deduct expenses, you can't prove.
Okay, what else?
Second, if you ever want to get financing for another deal or refinance the current property, lenders are going to want to see the LLC's financial statements. How has it been performing? Clean books make that possible. Third, again, think lawsuits. If you're challenged, you need to be able to show the legitimate financial operations of the LLC as a separate business. Messy or non-existent records make it way harder to defend against the argument that the LLC wasn't really run like a separate entity.
Any other practical reasons?
Yeah, Anderson mentioned things like applying for business loans or even government relief programs like the PPP loans during COVID. Businesses that couldn't produce clear, accurate financial records often got shut out. They couldn't prove their eligibility or their need. Using accounting software like QuickBooks, which they mentioned, really helps keep things organized properly.
So these 13 mistakes, they're not just small oopsies. They're fundamental errors in setting up and running the LLC that can completely wipe out the main reason you formed it, that asset protection.
Precisely. They're the chinks in the armor. You can file the papers to create the LLC, but if you fall into these traps, that shield gets weak, leaky, or might just vanish altogether.
Which brings us right back to the operating agreement. We flag skipping it as trap #10. It really seems like the key document for avoiding a lot of these problems, especially when you have partners in a real estate deal. Let's really unpack what needs to go into this thing, this blueprint and rulebook, drawing from UpCounsel, Northwest, and Lawyer's Mentor.
Yeah, the UpCounsel source nails it, calls it the foundational document. It defines the LLC's structure, how it's governed, its financial workings. And for real estate investors specifically, it's where you customize that standard LLC framework to fit the unique needs of owning and managing property with partners.
Like what kind of specifics?
Things like who's responsible for property management tasks? How do you decide on big renovations or when to sell? How does the money flow specifically from rental income, covering expenses, and distributing profits? Without spelling this out, like the Northwest source warned about disputes, you're stuck with state default rules, which probably aren't tailored to your deal.
So it's definitely not a fill-in-the-blank template you just download and sign. It needs real thought and tailoring.
Absolutely. It's your chance, maybe your only chance, to agree on all the rules before things get messy. So let's walk through some key sections you'd expect to find in a solid real estate operating agreement. First up, the basics. Company formation. This just confirms the official LLC name, its main address, hopefully that virtual business address we talked about, avoiding mistake, #45. It lists the specific things the LLC will do, like buying, owning, developing, leasing, managing, selling properties. Lawyer's Mentor gets pretty detailed there. It also states how long the LLC will exist. Modern LLCs are often perpetual, meaning no set end date unless something specific happens, as Lawyer's Mentor notes.
And it covers how the LLC ends or adds people.
Right. It defines the specific events that would trigger dissolving the LLC and, importantly, the formal process for bringing in new members later on, making sure everyone agrees on who joins the team.
Okay, then the money. Capital contributions. How does the agreement track what everyone puts in at the start?
This part is super important. It needs to clearly state what each member is contributing initially. Could be cash, could be property, maybe even services. It assigns a value to those contributions and spells out each member's starting ownership percentage, sometimes called units, like in the Lawyer's Mentor example. This percentage usually dictates their share of profits and losses.
What about needing more money later, like for a new roof?
Good question. The agreement has to address whether members can be required to contribute more capital down the road. Lawyer's Mentor talks about a capital call mechanism. This means the manager might decide the LLC needs more funds and can formally require members to chip in more, usually based on their ownership percentage. That's vital for real estate. Unexpected repairs happen, or maybe a great opportunity comes up that needs more cash. The agreement also needs to detail how separate capital accounts are kept for each member, tracking their contributions, distributions, and share of profits losses. This is actually an IRS requirement under Section 704B and crucial for taxes and tracking everyone's equity stake.
Speaking of profits and losses, how does the agreement handle profits, losses, and distributions? Who gets what and when?
This defines the money flow. The agreement spells out how profits and losses are calculated, usually following federal tax rules, as Lawyer's Mentor mentions. It says how those profits and losses are allocated to the members. Often it's just based on ownership percentage. But complex real estate deals might use fancier waterfall structures, where profits get split differently based on hitting certain return targets.
And getting cash out, distributions.
Critically, yes. It dictates when and how cash is actually distributed from the LLC back to the members. Northwest mentions maybe annually or maybe more often, perhaps enough to cover the taxes members will owe on the LLC's income. Lawyer's Mentor uses the term net cash receipts. The agreement makes it clear distributions are usually proportional to ownership after covering all the bills and maybe setting aside some reserves. Both sources stress you have to follow Treasury regulations, especially if the LLC dissolves. Lawyer's Mentor also adds that unless you write it differently, no member gets special priority in getting their initial capital back or receiving profits distributions of available cash happen at the same time based on the agreed percentages.
The management section seems absolutely critical with partners involved. How does the agreement clarify who does what, who calls the shots?
This is where you nail down that member-managed versus manager-managed choice. Trap #7. And get specific. If it's member-managed, okay, technically everyone could act. But a good agreement will assign specific jobs. Maybe one person handles leasing, another handles maintenance, another the books to create clarity. It sets up how decisions are made. Routine stuff versus big decisions like buying or selling a property, getting a major loan, approving a budget over a certain amount. Northwest suggests using majority vote for disagreements, but huge decisions might need a supermajority, or even everyone agreeing, unanimous consent, depending on what your partners decide up front.
And if it's manager managed?
Then the agreement names the initial manager. It defines their powers, usually broad authority to run the business day to day, sign contracts, hire help. It says how managers can be appointed or fired, and it specifies which major decisions still need the members' approval, often the really big ones, like selling the main asset or refinancing. The Lawyer's Mentor source gives the managing member lots of power, but requires unanimous member agreement for fundamental changes like dissolving the company, changing the agreement itself, or selling off the primary assets. It also includes a really important protection, saying managers or members acting in good faith generally aren't liable for LLC losses unless they were grossly negligent, engaged in willful misconduct, or clearly violated the agreement. That protects people from being sued for honest mistakes made while running the business.
What about paying members for their actual work, not just their investment, or covering expenses they pay out of pocket?
The compensation section handles that. It outlines situations where the LLC might pay a member for services they provide, like actively managing the property, instead of just being a passive investor. According to the Northwest template, paying members for services usually needs everyone to agree unanimously. It also covers getting reimbursed for approved expenses members pay personally on behalf of the LLC, tying back to TRAP #6. It clarifies the process for submitting receipts and getting approval. Then there's bookkeeping. This details how the LLC's financial records will be kept. Northwest mentions using a calendar year basis and keeping separate capital and distribution accounts for each member. This just reinforces again how vital accurate records are, TRAP #13, both for managing the business and for taxes and legal compliance. Lawyer's Mentor goes further, detailing the LLC's duty to prepare and file tax returns, like the Form 1065 partnership return, and issue those K-1s to members showing their share of everything.
It also mentions appointing a tax matters partner and the option of making a special IRS Section 754 election, which affects how a new member's tax basis is calculated if they buy into the LLC later, getting technical, but important in some deals.
Okay, a really common source of friction in partnerships is when someone wants out or life happens, death, divorce. How does the operating agreement handle membership changes and transfers?
This is arguably one of the most critical sections, and where a weak agreement can cause huge fights. It needs to lay out clear rules for what happens if a member wants to sell their share, retires, becomes disabled, dies, or even gets divorced, and their share becomes part of the settlement.
What's a common mechanism here?
A standard clause, mentioned by Lawyer's Mentor and UpCounsel, is the right of first refusal. Basically, if a member gets an offer from an outsider to buy their interest, The other members, or maybe the LLC itself, get the first chance to buy that interest on the exact same terms. Lawyer's mentor even details primary and secondary options for the remaining members to buy the shares proportionally. This lets the original partners control who they end up in business with.
But how do you agree on the price? The seller wants high, the buyers want low.
Exactly. The agreement must specify the valuation method. This prevents deadlock later. Common ways are agreeing on a formula up front, like say a multiple of the average cash flow, setting a fixed value that gets updated regularly by agreement, or, as Northwest suggests, agreeing to hire a neutral third-party appraiser if a buyout happens or if you can't agree on the value. Having this process locked down in advance is key to avoiding really nasty, expensive fights later. The agreement also needs to say what happens if someone tries to transfer their interest but doesn't get the required approval from the other members. Often, unanimous consent is needed, per Northwest and lawyer's mentor. If a transfer happens without approval, the new person might only get the financial rights, like the right to receive profits, but not the right to vote, manage, or even get information about the company.
So they get the money but no say.
Potentially, yes. Lawyer's mentor also adds rules limiting when members can just decide to withdraw or retire, and talks about a special member status, maybe for an estate after death, where they keep financial rights but lose management power. And, importantly, the agreement should state that anyone who does properly acquire an interest must formally agree to follow all the rules in the existing operating agreement.
We already hit the need for a separate bank account. Trap #12. Does the operating agreement say anything more specific about the bank account?
Usually, yes. The bank account section will typically name the specific bank where the LLC's main operating account is held. More importantly, as Northwest outlines, it assigns financial authority, who is allowed to sign checks, make deposits, authorize electronic payments, access online banking, and so on. This creates internal financial controls and reinforces that only specific, authorized people are handling the LLC's money, further separating it from anyone's personal funds. And, as Northwest reminds us, the bank itself will probably demand to see this signed agreement just to open the account in the first place.
Planning for the end seems wise, too. That falls under exit strategies and dissolution.
Right. UpCounsel really stresses thinking about how the venture might eventually end. This section includes those buy-sell or buyout clauses we talked about under transfers, triggered by certain events. It also specifies what triggers the formal dissolution of the entire LLC. Maybe it's a unanimous vote, maybe a specific event occurs, maybe laws change, making the business impossible, as UpCounsel notes. It then details the winding up process. How do you liquidate the assets? How will the properties be sold or maybe distributed directly to the members? Lawyer's mentor specifies distributing remaining assets based on everyone's final positive capital account balances. And it includes legal clauses common in real estate deals, like a waiver of partition rights. That's important. It prevents one unhappy partner from running to court to force the sale of a specific property if the other partners want to keep it. Stops one person from unilaterally breaking up the portfolio.
And lastly, but maybe most importantly for keeping the peace, dispute resolution clauses. The WA Business Law blog source really focused on this.
Absolutely critical. Because, as that blog points out, even partners with the best intentions can end up in serious disagreements. And if your dispute clause is vague or poorly written, it can actually make things worse. The operating agreement needs to proactively spell out the specific steps the members agree to follow if they have a fight about the agreement or the business, trying to avoid jumping straight into expensive relationship-destroying lawsuits.
What kind of steps are usually included?
The blog details a common tiered approach. 1. Negotiation. First, usually the partners just have to talk directly, maybe with their lawyers present, often for a set period like 30 days, to try and work it out themselves. 2. Mediation. If talking doesn't work, the next step might be mediation. You bring in a neutral third party, the mediator, who helps facilitate the conversation and explore possible solutions. Crucially, the mediator doesn't make a decision. They just help the parties communicate. It's less formal and often cheaper than court, but it's non-binding. If you don't reach an agreement in mediation, the dispute moves on. 3. The binding step, arbitration or litigation. If mediation fails, the agreement must specify the final binding way to resolve it. The two main options are arbitration. The partners agree to present their case to a private arbitrator, or panel of arbitrators, who acts like a judge, hears the evidence, and makes a final binding decision called an award. The blog notes arbitration can be faster, more private, and potentially less formal than court. A key feature you can include is making the arbitrator's decision final and non-appealable, which brings quicker closure, though arbitration can still be expensive. Litigation. This is the traditional route, filing a lawsuit and going through the court system. If you choose this, the agreement should specify where the lawsuit must be filed, which state, which court, to avoid fights over jurisdiction. The WA Business Law blog really stresses you have to carefully choose between arbitration and litigation as your final binding method, and make sure the clause is written clearly to cover all potential disputes related to the business. It forces you to think about the worst-case scenario up front and agree on a structured process, which hopefully saves relationships and money compared to an all-out court war.
Wow. That is an incredibly detailed blueprint. It makes it crystal clear that a serious real estate LLC operating agreement is way more than just some generic template. It's a deeply customized contract for a complex partnership.
It absolutely has to be. It needs to anticipate the specific challenges, the decisions, the potential pitfalls inherent in owning and managing property with other people involved.
Okay, so we've covered the essential structure, avoiding those 13 traps, and the absolute necessity of that detailed internal rulebook, the operating agreement. Now let's pivot to the other side of the coin. External compliance, specifically tax reporting for these real estate LLCs. This is where we bring in the IRS view, focusing on Schedule E, based on those official instructions you found.
Right. This is where the rubber meets the road, where the LLC's activities hit your personal tax return. Schedule E, Form 1040, Supplemental Income and Loss. That's the main IRS form individuals use to report income or loss from rentals, but also from pass-through entities like partnerships and S corporations.
And since an LLC can be taxed in different ways...
Exactly. Since an LLC might be taxed as a disregarded entity, like a sole proprietor for tax purposes, or a partnership, or an S corp, Schedule E becomes highly relevant for reporting its results on your 1040. C corp file their own separate returns.
So depending on how my LLC is taxed, I'll be using different parts of Schedule E.
Generally, yes. If your LLC is treated as a disregarded entity, single member, or a partnership, multi-member default, and it owns rental property, you'll primarily use Part 1 of Schedule E to report the rental income and expenses directly. Now, if your LLC elected S corp status, or if it's a partnership holding maybe other types of investments, or if you just receive a K-1 form reporting your share of income or loss from an LLC taxed as a partnership or S corp, even if it holds real estate, that information usually flows on to Part 2 of Schedule E.
Okay, let's focus on Part I first, the direct reporting of rental real estate. What are the main things the IRS wants to see there?
Part I is where you list each rental property you own, usually separately. You give the address, say what type of property it is, like residential, commercial. For each one, you report the total gross rental income you received. Then you list out and deduct all the ordinary and necessary expenses you pay to operate that rental property.
What kind of expenses are typical?
The IRS instructions list a bunch. Advertising, auto and travel costs related to the rental, cleaning, maintenance, commissions paid to rental agents, insurance, legal and professional fees, management fees, repairs, supplies, taxes, like property taxes, utilities paid by you, and a big one, depreciation.
What about things you can't deduct there, according to the instructions?
Yeah, they're clear on a few key things. You can't deduct the value of your own time or labor if you do work on the property yourself. Big improvements that add significant value or extend the property's life, those usually aren't expensed immediately. They get capitalized, meaning added to the property's cost basis, and then recovered slowly over time through depreciation. And there's a quirky old rule. The basic charge for your first home phone line is considered personal, not deductible, even if you use that phone for rental calls.
The IRS source went into a bit more detail on some specific expenses, like auto and travel related to the rentals.
Yes, if those trips are ordinary and necessary for the rental activity, like driving to the property to manage it, do repairs, meet tenants, those costs are deductible. If you travel away from your tax home overnight for the rental, you can deduct 50% of your meal costs during that travel.
And for the car itself?
You have two options for deducting car expenses. You can track your actual costs, gas, oil, repairs, insurance, depreciation, etc., but only the portion related to your rental activity mileage. Or you can use the standard mileage rate set by the IRS each year. For 2024, that's 67 cents per mile driven for rental purposes, plus you can add parking fees and tolls. The actual expense method usually requires more detailed records. And if you claim actual expenses or depreciation on a car you started using for the rental this year, you'll likely need to file Form 4562, Depreciation and Amortization.
What about paying, say, your accountant or lawyer for help with the rental property stuff?
Good question. Fees you pay for tax advice or for preparing the rental-related parts of your tax return, like Schedule E, are deductible. They go on line 10 of Schedule E, Part 1. But legal fees paid to defend or perfect your title to the property itself, like fighting a boundary dispute, those are generally not deducted immediately. They're considered capital expenses, added to your cost basis in the property.
Mortgage interest, that's usually a big deduction, right?
It often is, yeah. The IRS instructions talk about tracing rules from Publication 535. Basically, you deduct interest based on how the loan money was used. If you borrowed money to buy or improve the rental property, the interest is generally deductible as a rental expense on Schedule E, line 12. They also mention that other rules, like the business interest expense limitation, might limit your deduction, potentially requiring you to fill out Form 8990 first.
And depreciation, that lets you write off the cost of the building over time.
Exactly. Depreciation is a super important annual deduction. It lets you recover the cost or other basis of the property, the building, not the land, over its expected useful life. You start depreciating when the property is placed in service, meaning ready and available to be rented.
How is it calculated?
The amount is figured using specific IRS methods and recovery periods. For residential rentals, it's typically spread over 27.5 years. For commercial, it's usually 39 years. You generally need to use Form 4562 to calculate your depreciation deduction, and you must attach Form 4562 if it's the first year you're depreciating that property, or if you're depreciating certain types of property like cars, or taking a Section 179 deduction, though Section 179 usually doesn't apply to buying buildings. Land itself, remember, is never depreciated.
The instructions also spent quite a bit of time on what happens if you use the rental property yourself sometimes. The personal use of dwelling unit rules. They sound complicated.
They definitely can be. It's a common area for errors or even audits. A dwelling unit isn't just a house. It could be an apartment, condo, even a boat if rented out. The rules apply if you use the unit for personal purposes and rent it out during the year.
What counts as personal use?
Used by you, your family members, unless they pay fair market rent and it's their main home, anyone paying less than fair rent, or use under a house swapping arrangement. However, days you spend there working substantially full-time doing repairs or maintenance don't count as personal use days.
Okay, so what's the key test?
The main threshold is whether your personal use was more than the greater of these two. 14 days, or 10% of the total days the unit was actually rented out at a fair price.
And if my personal use was less than that threshold?
If your personal use didn't exceed that limit, then you didn't use it as a home for tax purposes. In that case, you can generally deduct all your rental expenses, although they might still be limited by other rules, like the passive activity loss rules we'll get to.
But what if my personal use was more than 14 days or 10% of rented days? I did use it as a home.
Okay, if you did use it as a home, then you look at how many days you actually rented it out. There's a special, simple rule. If you rented it for fewer than 15 days total during the year, you generally don't report any of the rental income, and you don't deduct any of the rental expenses on Schedule E. Easy peasy. You might still deduct some mortgage interest and property taxes on Schedule A as itemized deductions, subject to those limits.
And if I used it as a home and rented it for 15 days or more?
Then it gets more complex. You must report the rental income. But your deductible rental expenses are limited. You generally can't deduct expenses that exceed your gross rental income from the property for the year. And crucially, you have to allocate most expenses between the rental use days and the personal use days.
How does that allocation work?
For expenses like maintenance, utilities, depreciation, you generally allocate based on the number of days used for each purpose. For example, if you used it 10 days personally and rented it 90 days, 100 total use days, you'd allocate 90%, 100 of those expenses to the rental activity, deductible on Schedule E, subject to the income limit, and 10% to personal use, not deductible as rental expense. For expenses like mortgage interest and property taxes, the allocation method can be slightly different, often involving total days in the year for the personal portion deductible on Schedule A. It gets tricky.
That difference between using it as a home and the 15-day rental threshold is really key. Okay, what was that qualified joint venture thing?
The QJV. This is a special election just for married couples who are the only members of an LLC or just own property directly that operates a rental business, and they file a joint tax return.
What does it let them do?
Instead of being automatically treated as a partnership, which would force them to file a separate Form 1065 partnership return, they can elect QJV status. This lets them report their respective shares of the rental income and deductions directly on their joint Form 1040, usually on Schedule E, Part 1. The IRS says they should basically report it as if they each had separate properties, splitting the income and expenses.
So it simplifies the filing, avoids the partnership return.
Yes, simplifies filing.
Yeah.
But the IRS is clear. The QJV election does not change the underlying tax rules about self-employment tax liability, if applicable, or, very importantly, the passive activity loss limitations. Those still apply.
Okay, speaking of those limitations, the IRS source spends a lot of time on limitations on losses. If my real estate LLC ends up with a loss for the year, especially if it's taxed as a partnership or disregarded entity, I can't always just deduct it against my other income, right? What are these different layers of rules that block or limit losses?
This is where things get really complex, and you have to apply the rules in the right order. The IRS instructions outline 4 main hurdles or limitations that might stop you from deducting a loss shown on Schedule E. First is the basis rules. This applies mainly if your LLC is taxed as a partnership or S-corp. You simply cannot deduct losses that are more than your adjusted basis, basically, your investment in your ownership interest at the end of the LLC's tax year. Your basis starts with what you put in, goes up with income, down with distributions and losses. Any loss you can't deduct because of basis. It gets suspended and carried forward to future years when you hopefully have enough basis.
Okay, basis first. What's next?
Second are the at-risk rules. You generally figure this on Form 6198. These rules limit your deductible loss to the amount you personally have at risk in the activity, meaning money or property you've contributed for which you could actually lose your investment. This applies to most activities, including rentals and pass-through entities.
Is there an exception for real estate debt, like mortgages?
Yes, critically. There's an important exception for qualified non-recourse financing secured by real property. Generally, non-recourse debt, where you're not personally liable, doesn't count towards your at-risk amount. But this special type of non-recourse financing, common in real estate deals, like a standard mortgage secured only by the property from a qualified lender, is treated as an amount at risk. This often allows real estate investors to deduct losses funded by this type of debt, even if they aren't personally liable beyond the property itself.
Got it. Basis, then at risk. What's hurdle number 3?
Third, and often the biggest one for real estate investors, are the passive activity loss, PAL rules. You calculate these on Form 8582. The general rule is that rental activities are automatically considered passive activities no matter how much time you spend on them, unless you qualify for an exception.
And what's the consequence of being passive?
Losses from passive activities can generally only be used to offset income from other passive activities. You usually cannot use passive losses to offset non-passive income, like your W-2 salary from a job, interest and dividends, portfolio income, or income from a business you actively run.
So if I have a rental loss but only W-2 income, the loss might be stuck.
Exactly. If your total passive losses exceed your total passive income for the year, the excess passive loss is suspended. It gets carried forward to future years, where you can use it against future passive income. Or, generally it's released and becomes deductible if you sell your entire interest in that passive activity in a fully taxable transaction.
Okay, that PL rule sounds like a major roadblock. Is there a 4th limitation?
Yes, a newer one, the excess business loss, EBL rules. You figure this on Form 461. This applies after the basis, at-risk, and PL rules. It puts an overall cap on the total amount of net business losses from all your trades or businesses combined, including potentially real estate, if it rises to that level, that a non-corporate taxpayer can deduct in a single year. For 2024, that limit is $300,000 for single filers, $600,000 for married filing jointly.
What happens to losses above that cap?
Any business loss exceeding that EBL threshold is disallowed for the current year. It's treated as income on Schedule 1 of your 1040 and then carried forward to the next year as a net operating loss. NOL. This applies even if the loss was considered passive under the PL rules, but made it through those limitations somehow, like offsetting other passive income.
Wow. Basis, at risk, passive activity, excess business loss. That's quite a gauntlet before a real estate loss actually reduces your overall taxable income.
It really is. And you have to navigate them in that precise order. For many buy and hold rental investors, the passive activity loss rules are often the main barrier.
Are there ways around the passive activity rules for rentals? Any exceptions?
Yes. The most significant one, especially for people heavily involved in real estate, is qualifying as a real estate professional for tax purposes.
What does that status do?
If you meet the specific IRS tests to be a real estate professional, and you also materially participate in your rental real estate activities, then those specific rental activities are not treated as passive.
Meaning the losses aren't automatically limited by the PAL rules.
Correct. If you meet both conditions, real estate pro status plus material participation in the rentals, You can potentially deduct losses from those rentals against any type of income, your salary, investment income, whatever, without being restricted by the passive loss limits. It's a huge potential benefit.
Okay, but qualifying sounds tough. What are the actual tests to be a real estate professional?
It's a two-part test, and you have to meet both parts every year. 1. More than half of the total personal services you perform in all your trades or businesses during the year must be performed in real property trades or businesses where you materially participate. 2. You must perform more than 750 hours of service during the year in real property trades or businesses where you materially participate. And real property trades or businesses is defined pretty broadly: development, construction, acquisition, rental management, leasing, brokerage, etc. But importantly, if you work as an employee in a real estate company, those hours only count towards the test if you own more than 5% of that company.
That first test, more than half your total work time, sounds really hard if you have a demanding full-time job outside of real estate.
It absolutely is. That's often the disqualifier for people who invest passively or part-time while holding down another career. If you don't meet both the more than half your time test and the 750 hours test, you are not a real estate professional for tax purposes, and your rentals generally remain passive by default.
Okay, let's say I do qualify as a real estate professional. Is that enough? You mentioned a material participation, too.
Right. Qualifying as a real estate professional is step 1. Step 2 is you then have to prove you materially participated in each of your rental activities, or your combined rental activities if you make a special election. Material participation basically means your involvement is regular, continuous, and substantial.
How do you prove that? Is it just hours?
The IRS has 7 specific tests for material participation. The most common ones people rely on for real estate are things like spending more than 500 hours on that specific activity during the year, or your participation was substantially all the participation in that activity by anyone, including non-owners, or you participated for more than 100 hours, and that was at least as much as any other individual involved. It's a facts and circumstances test, but hours often play a big role.
Can you combine hours across multiple properties?
Yes, if you qualify as a real estate professional, there's a very helpful election you can make. You can choose to treat all of your interests in rental real estate as a single, combined activity just for the purpose of meeting the material participation tests. So instead of needing, say, 500 hours on property A and 500 hours on property B, you might only need 500 hours total across both combined to materially participate in the single elected activity. But you have to formally make that election. It's also worth quickly mentioning active participation. This is a much lower standard than material participation. If you own at least 10% of a rental property and you genuinely make management decisions, like approving tenants, deciding on repairs, you might meet the active participation standard.
Does that make the losses non-passive?
No, unfortunately not. Active participation doesn't override the passive nature of the rental activity itself. However, it does potentially unlock a limited exception. If you actively participate, you might be able to deduct up to $25,000 of passive rental losses against your non-passive income each year. But this $25,000 allowance phases out quickly based on your income. It starts disappearing once your modified adjusted gross income, MAGI, hits $100,000 and is completely gone by $150,000 MAGI. So it helps some moderate income landlords, but it's not the full exemption that real estate professional status offers.
Wow. Okay. So navigating the tax side really involves understanding your LLC's tax status, how you get money out, how different income and expenses are treated on Schedule E, and then correctly applying this whole cascade of loss limitations basis, at risk, passive activity with its potential exceptions, and excess business loss, all based on your specific tax situation and how involved you actually are.
That's a perfect summary. It's multifaceted. And just like we talked about with keeping the LLC structure sound, the IRS instructions for Schedule E end with a strong reminder about record keeping. You absolutely must keep accurate, complete, contemporaneous records to support everything you report: income, expenses, deductions, credits, your basis, your hours if claiming real estate pro status. Good records make tax prep easier, help you claim everything you're entitled to, and are your first line of defense if the IRS ever asks questions. It loops right back to the importance of avoiding trap #13 neglecting proper books.
This has been incredibly thorough, a real deep dive into the actual mechanics of using LLCs for real estate, especially with partners. We've seen that, yeah, forming the LLC is step 1 for asset protection, but whether that protection actually holds depends entirely on avoiding those critical setup and operating mistakes.
That's structural integrity built by paying attention to the details like state filings, the right addresses, separate bank accounts, documented procedures. That's the real foundation for the liability shield. It's not just the piece of paper.
And that operating agreement, it's not just some template you sign and forget. It's the absolute core internal contract. It's the customized rulebook that needs to govern everything. How money moves, how partners decide things, how you handle fights, how you plan for changes, or the end game.
It truly defines the partnership within the LLC structure. It's your best tool for preventing misunderstandings and disputes before they even start.
And then finally, really getting a handle on the tax side, how the LLC structure impacts your personal return via Schedule E, and navigating those layers upon layers of loss limitations basis at risk, the big one being passive activity rules, and maybe the real estate professional exception that's just crucial for compliance and for the actual financial outcome of your investment.
Yeah, the legal protection and the tax treatment, they're really two sides of the same coin. If you mess up one, you often weaken the other.
So the key lessons, the takeaways from digging through all these sources, they seem pretty clear. 1, form your LLC before you do any business in its name. 2, sweat the small stuff on structured the state filings, registered agent, proper address, separate bank accounts used correctly, good bookkeeping. Those are non-negotiable for keeping the liability shield strong.
Absolutely. Meticulous attention to those formalities.
3, invest real time and thought into crafting a comprehensive operating agreement. Tailor it specifically to your real estate partnership, your goals, and anticipate problems like member exits or disagreements by having clear resolution procedures.
Don't just use a generic form. Make it fit your deal.
And 4, understand the tax consequences. Know how your LLC is taxed, how that flows to Schedule E, and critically, understand how your level of involvement impacts those loss limitation rules, especially the passive activity rules. Report correctly.
It's definitely an ongoing process, isn't it? Not just a one-and-done filing.
For sure. Which leaves us with maybe one final thought for you, the listener, to chew on after all this detail. Considering all this complexity, avoiding those 13 common traps, drafting an operating agreement that truly covers all the bases for a multi-partner real estate deal, navigating the maze of tax reporting and loss limitation rules. Does relying just on online templates or trying to DIY the whole thing really give you the solid protection and peace of mind you need when significant money and partnerships are involved?
Or perhaps is spending the money up front for tailored advice from experienced legal and tax professionals actually the smarter, maybe even cheaper path in the long run? Is that the real shortcut to building a genuinely solid, defensible foundation that protects your assets and your partnerships for the long haul? Something definitely worth thinking about as you plan your next steps.